Welcome to Zoom Out with Toads, it says. This is Robin Lin, and I'm sharing with you our Q3 2023 outlook. This is part three, the meat and potatoes, the crystal ball for the second half of 2023 and into 2024. So let's get started. Of course, we start with disclaimers. This is not investment advice. Please don't take it as such. Remember, I'm biased, I have blind spots. This is for your entertainment only. This is not investment advice. Okay. So let's dig in. The first question is obviously recession. We've been talking about this for a long time, since the beginning of the year. Hard landing, soft landing, no recession, et cetera, et cetera. Currently, the Wall Street is thinking that we're having a soft landing instead of a hard landing. But it's interesting that there's some who are now thinking that there'll be no landing, essentially meaning there won't be a recession. We'll keep economic growth going throughout. And the Fed has done a magical job of slowing things down without causing an economic crash. Okay. Bank of America itself has now decided, no, we are not going to have a recession. They see GDP growth continuing above the 0% level into 2024. So they're kind of saying, well, yeah, the Fed did a great job, a magical management of unemployment, interest rates, and inflation looks good to them. Okay. However, when we think about GDP as a way to indicate or way to evaluate the economy, what's really interesting here, comparing GDP to GDI, which is gross domestic income. You can read the notes here, but basically GDI is wages, profits, taxes, rental income, interest income, minus production imports, and other statistical discrepancies. You look at this correlation, mostly is very, very tight. And then suddenly we have this weird, big divergence here. Don't know what this means. I just know that it could be important. That the way we calculate GDP maybe looks okay on the surface, but what's under the surface, what's actually generating wages and profits for Americans and how we deal with those issues, that is diverging in the wrong way. And it could mean we don't have, quote unquote, a recession, but we feel like we're in a recession. Somebody put together this chart, which I thought was interesting. I don't know actually who made it, but I thought it was interesting how they defined different scenarios of we're in full recession, soft landing, and then higher for longer, meaning interest rates, the 10-year interest rates being above 425. If it were above 45.25, the scenario would be we're about where the S&P 500 would max out. With a soft landing scenario, we could see that the S&P 500, the stock market, continue to move up further. And if we were really in a recession, it would probably fall down with these kind of, with these kind of yields on the 10-year U.S. Treasury notes. This is something that markets right now feel it's a soft landing, and they always tend to think it's a soft landing when we are about to have the Fed pause their tightening measures. This could be a false signal, so let's see how that turns out. I find this chart extremely interesting, almost a perfect inverse correlation between inflation and how the stock market does. If we are correct, we discussed that the inflation may be sticky and may in fact actually return, we could probably just inversely expect the stock market to perform similarly. History rhyming, it's eerie how well this chart fits. Of course, chart fitting isn't exactly a cause and effect relationship. It happens just to be a correlation, but the blue line was the inflation from 1966 to 1982. And our current inflation rates is in the orange, beginning in 2013 to now. And it's eerie how well this fits. We could be in the sideways part, and I am concerned that inflation will be sticky and will rear its ugly head again, given previous, part one and part two that we discussed about The supply constraints and a lot of critical commodities versus better than expected demand from this era. Um, we'll see if this actually becomes a double hump, but definitely it's something worth noting and worrying about. Going forward, the consumer, the Fed did a great study, and this study was based off of the BEA agency's estimates of accumulated excess savings. We gained a lot of excess savings, specifically during the COVID era, where the government essentially just gave money out, the stock markets roared, et cetera, et cetera. But after the pandemic, we started to spend that down, and this money and spending has really carried us through the last few years. By these studies and also by the Fed study, it looks like the excess savings is drying up. So 300 billion is left. According to this analyst, they think it's going to be depleted by September. The Fed report said it'd be by the end of the year. I think JP Morgan, Jamie Dimon also mentioned something about towards the end of the year. Suffice it to say, the excess savings that Americans have saved up and have been spending over the last couple of years, the resilience, retail sales, and travel and eating out and all those things, it could be winding down, and we might feel the full effect of that basically next year. When it comes to unemployment, this is concerning. Each monthly unemployment rate is just a snapshot. What is more important typically to economists is the direction of revisions. So they report it, and then a month later they revise and say, no, 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 this is actually what we think. Every revision over the last 6 months has been revising unemployment rates or job growth downward. So essentially unemployment rates being a little bit higher than what really is happening. When we dig down further into the July unemployment numbers, you see we gained about 1 million part-time workers, but we lost 500,000 full-time workers, which is really not a robust job environment, if you ask me. The number of multiple job holders it keeps climbing, and that means even if you have a day job, you probably aren't making enough and need to supplement with a side job or a part-time job. It seems like Americans are working harder and harder to try to keep above water. When we look at the average weekly hours, that has been trending downwards, which is also a concerning sign. Overall, the US employment labor markets seem to be having a labor hoarding effect. You hear business owners basically had such a hard time during the COVID era of finding qualified people. They just don't want to let them go because they worry about not being able to rehire people if things are good. Meanwhile, retail sales, GDP have been going okay. So I think a lot of business owners have been hanging on for dear life, trying to keep their employees as long as they can, not firing them as long as the economy continues to go sideways. So let's see how that evolves. If the economy starts to decline, it could be that many of these business owners will be forced to cut costs, increase layoffs, or fire people, cut hours to try to save costs. And that could be detrimental to wages and spending capacity for consumers. It seems like people are having a harder and harder time with just having enough money for emergencies. This has been in the news quite a bit. So how are people dealing with it? It could be that they're tapping their credit cards, their 401k plans. Some with homes are able to tap into home equity line of credits, HELOCs, to get some extra money out of their houses. All of this is concerning as amount of debt has been increasing. The amount of defaults is starting to increase. And in aggregate, you see this big jump over the last couple of years of auto loans and credit card delinquencies ramping up. That's quite concerning. Meanwhile, as we mentioned earlier, the price of gasoline is going up. That has a lot to do with better than expected demand, and reducing supplies of, energy, oil in general. Overall, the barrel of crude oil has jumped since, where is this, June, end of June, and it's still up in the $80 range. We think maybe it could keep going, and there are some people who are expecting the top range up around 93, and being a critical resistance level to see if it would shoot further or bounce back down after that. Natural gas has also been extremely cheap for a while, and now we're getting into the fall and winter outlooks. There have been strikes in Australia, which is a major liquid natural gas producer. There have been, production bottlenecks happening elsewhere with ports and things like that. Europe, which is now probably the largest liquid natural gas importer in the world, due to the Ukraine war, they have storage facilities for around 4 months of use. And last year, the winter was milder than expected. They filled those up. They're right now up around 100% capacity of storage. But what we're seeing is also we've had massive heat waves, which drive demand for air conditioning, and we're seeing different issues around the world. And with El Nino forecast to be hitting the fall, it could end up having a cold winter in Europe. So with those factors in play, that the supply is as it is, the storage, although high in Europe, could draw down, and within 4 months it could be drained. Natural gas prices are starting to move with uncertainty about weather and production. So that's of interest. The airlines, the American airlines, they definitely had a revival of travel and interest to travel in 2021, 2022. But this year it's really been slow. And it feels they've been forecasting even further slowdown, which is interesting because that means the domestic travel is slowed down significantly. What has been doing okay has been international travel. So to balance those two things, it's interesting to think about what drove the international travel and why the domestic travel is slowing down. So that is something to watch, as this is a very consumer leading indicator. Overall bank willingness to make consumer loans, when people use this also as a leading indicator to expect how retail sales will go. And you're seeing the Walmarts and the Targets and everybody, the big retailers, having decent results so far, but they still are very concerned about this fall and winter season. So they've been hedging their bets, let's say, for the last quarter of sales and profits. On the good side, household formations in the US have been still healthy. This specifically means millennials are getting married and having kids. Okay, so they're driving demand for houses. Instead of living in apartments or in mom and dad's basement, they're moving out and looking for housing. This is coming at a very difficult time, however, as the cost to rent versus the cost to buy, they've just been ramping up dramatically. This is definitely driven by the fact that mortgage rates are now up in above 7%. And home prices, they have come down in certain hot markets, but the national average is still quite stable and a little bit higher than expected, excuse me. The debt to income ratio for home buyers, we're at more debt, less income ratio. It's an extreme burden for home buyers, and it's already worse than it was in the 2006, 2007 era, where homes blew up and then melted down. So net, the affordability of buying a home is at an all-time low. And that makes it very difficult for those millennials who are looking to find a home to actually be able to afford one. And that's a big burden. On the corporate side, because this is another component of GDP, I want to reiterate this slide that I've shown previously on the small to mid-sized banks. Banks with less than 250 billion in assets, they make up 50% of the commercial and industrial lending, 60% of residential lending, but 80% of commercial real estate lending. So this is a big issue. The black lines are where the big mega banks live, and they're relatively stable and safe. The blue line is where the small to mid-sized banks live. And they have a lot of issues that they're facing. Overall, commercial real estate has really been under pressure. The values have come down. The loans, as they come due, people have to decide whether they're going to pay their loans or just hand the keys back to the banks. These are big issues. We've talked about it since the beginning of the year. It hasn't stopped. Delinquency rates on a lot of commercial real estate lending has been climbing. Specifically, mainly in the office segment, has climbed really quickly. But this is something that is ongoing. We continue to need to watch this as these loans mature, and they have to make decisions on what to do. Okay, and this is an old slide, but this is just to highlight. In San Francisco, there have been office buildings, hotels, retail outlets. It's really bad there. This is not just in San Francisco. This is all over. LA has these issues. DC has these issues. And as the economy unfolds and as interest rates continue to rise, this pressure only continues to grow. So banks, as we mentioned earlier, they're under pressure. And when you're under pressure, you don't want to take risks. You want to hoard your deposits, have the cash, so you have all the capital ratios to prevent a bank run. However, all the lending that you used to do to actually make money, you've been worried, and you see a slowdown in this and slowdown in that. So you're seeing commercial lending, commercial bank credit drop precipitously. This is the first negative growth rate in bank credit since 2008. So this is an early warning signal. The other way to see it is also where they survey all these senior loan officers at the banks and just say, hey, well, what do you think? How is it going? They have basically been in a tightening mode. They forecast further not lending by banks, and going into the end of the year and into next year, it looks pretty dire, in fact, that the banks just want to hold on. They don't want to lend, and that doesn't promote any kind of economic growth, lending for office building or building new factories, things like that. Okay. Russell 2000 is an index that tracks mostly the smaller cap stocks, but up to 40% of these small cap stocks are experiencing negative earnings. So they're very susceptible to a negative downturn in the economy. If they were funded at all by selling bonds, when those bonds mature, are they going to be able to roll them over, reissue them? These are the funding of these businesses that are experiencing negative earnings becomes a greater problem. And this is part of where a lot of the bankruptcies start to evolve. Corporate profits have also declined. Profit margins, although they're not horrible, they're not below trend yet, but if the direction is still towards that, we'll probably see some effects in the stock market. As far as corporate debt, this year remains relatively bearable, but we see a little hump over the next couple of years. So funding pressure grows all the way into 2026. Then there's another big one in 2028. But what happened was when interest rates were low, all the chief financial officers of the big companies, they realized they could borrow super cheap and they could probably grow a lot faster than what they had to pay. So they borrowed a lot, And depending on how far out they had the maturity set, they have that many years or that much time to generate enough profits to pay off these loans. So, however, as interest rates have shot up, if you were Apple and your bond matures in 2026, if interest rates are still high in 2026, you would probably not want to refinance it, or you may worry about having enough cash to refinance it. In essence, the companies will have to really manage their cash flows against growth. And if they don't expect the growth to be there, the first thing you do is cut costs. And that tends to be a lot of negative for jobs. Inventories over sales is another indicator. When you have too many inventories, too much inventory, or too few sales, this index rises. And the sales issue is of concern now, as if you can't sell through, you're not going to, be able to keep all that momentum, and global trade would likely have some impact. Small businesses also don't feel this is a great time to be expanding. I think this is very much a hunker down mode, labor hoarding, but then if things turn bad, you're going to have to let people go. The conference board is an entity that tracks a lot of indicators. They have a leading indicator index, which has been very reliable and fairly credible over the last decades. They've been going down for 16 straight months. They do expect the economy to slow. I think the underbelly of the world, the U.S. economy is slowing. It just hasn't slowed to the amount that triggers a full recession. However, the underlying leading indicators are telling you that things are not good. Although we are seeing a little bit of rebound, we'll see if that continues to spike back up or not. On the bright side, we're seeing construction spending in US manufacturing. This is a new renaissance. This is driven a lot by Biden's policies to try to reshore critical industries back to the US. If you took out the red, it would be going sideways, but you see the red part is computers, electronics, electrical. This is probably heavily driven by the government policies that are incentivizing / forcing semiconductor plants to be built on US soil. So when we look at the activity of all the planned manufacturing, you're seeing the darkest load right here in Arizona, which is the site of where Samsung and Taiwan Semiconductor are building new massive semiconductor plants for high-end advanced semiconductor chips. This could be one of the biggest drivers of this, and it's great. It's very important for the U.S., but it's localized to certain states, let's say. Now, what is the government doing? The government plays an important part in all of this. It's the foundational part. This is a slide that I created in the last Outlook. We were talking about the debt ceiling, the Treasury General account, and with the debt ceiling being resolved in Congress in June, we have now moved on to this part, where the Treasury bond supply, the U.S. Treasury, they've run out of cash. Their piggy bank's empty. They need to replenish this so that they can pay for running the United States. That's military, that's Social Security, Medicare, everything. They're recharging that battery, and they also need to meet the new budget deficit, which is over $2 trillion. So they're selling a lot of US Treasury bonds. And the expectation is it's going to be, 1.5 to 2 trillion of net new Treasury bonds. And this is a massive amount of Treasury bonds. And when you think about who's buying it, the domestic and the international, there feels like there's an imbalance, okay? And what would happen is US Treasury yields start to rise. And we've already been seeing that. And we're also seeing that the U.S. debt service is what we pay to pay for all the interest that we're borrowing in U.S. Treasuries. That's climbing. That's already up to $1 trillion a year now. So this is a big concern domestically. Sure, a lot of the institutionals, the banks, even now retail investors are now more interested in buying some of the U.S. Treasury bonds, particularly towards the short end, the bills, the 0 to 2 year bonds. But the longer end bonds are really not attractive right now, and they're being shunned. So those yields have been climbing rapidly. Internationally, other foreign central banks, other industries, other country corporates, they need dollars. Well, they sell things and they usually make them in dollars. They even borrow money by issuing bonds in dollars. And what happens is as they sell more, they collect US dollars. And if they have excess US dollars, that's where they look to US bond markets, US Treasury markets to park it and earn some interest. Well, if the global economy is slowing down, there are less dollars floating around, there's less excess dollars floating around, therefore there's just less demand for US Treasuries. So that is a very important and concerning factor in the demand side. This is typically called the euro dollar market for whatever reason. It's a weird name for just global international US dollars and what that does to US Treasury bond demand. But these factors added together against a massive tsunami of supply is concerning. The concerns are going to be valid, and if the debt services still climb, if yields still climb, the Fed may be pressured into trying to keep those yields within a range, to keep them under control so that they don't spike up to ridiculous levels and cause a global financial crisis. So the next step, I think, is some form of official yield curve control by the Fed. And the way that works is like Japan, which has done it for, I don't know how many years, but several years now. It essentially is another form of QE, where the government's printing up money and buying US Treasuries unlimited amounts so that the markets don't challenge it. This is a stealth form of QE. And if that were to arise, I think you would expect risk assets, that money eventually filtering down into investor pockets and risk assets reviving and doing well. Okay. So let's continue on. A recap of this slide of the budget deficits year by year. These are the forecasts from the CBO. It's just been reported by this company. It's not a pretty picture. Where government debt to GDP for the United States is top 4. It's over 130% now, whereas in 20 years ago we were only at 50%. That would be a healthy way to keep running things. This becomes concerning. Okay. Having said that, the U.S. is the world's currency reserve, and we get away with a lot more than other countries, and our military is strong, so we get away with other things. However, just to keep that in mind, that as this number climbs, it tends to be a dampener on economic activity. The government crowds out healthy economic activity and growth, and it's a kind of a double-edged sword. You can keep things running, but you're kind of crowding out future growth. Okay, so and just for you to have a profile how the U.S. is issuing the U.S. Treasuries, it's very much the dark bar 0 to 2, the short end of it. That's the majority of the U.S. Treasury sales, U.S. Treasury bond sales. Less at the longer end. That's good and bad. I would say that a normal company, if you want to borrow at low rates, you want to have that mature as late as possible. But if you are borrowing at shorter time frames, every time the Fed raises interest rates, it makes your interest expenses go up. So this is going to cause interest rates on U.S. Treasuries to keep going up as they reset at higher and higher interest rates. Tax revenue. The federal government collects taxes from all of us, and when we get a dip down, that typically is a very recessionary indicator. So just a thought. Here's a great chart that says government deficit spending. When it spikes, loan growth tends to fall. It seems to be a fairly stable inverse correlation. That's where I mean, when government debts are so high, it crowds out healthy economic activity, which is actually what we need to grow out of all our problems. Now that the interest expense that we're paying is $1 trillion a year, that's costing 6.3% of our GDP. And if this continues to go up, again, it's crowding out money that we could have used to invest in infrastructure or build new factories or improve education. Okay. Whenever the yields on treasuries rise, it tends to have add-on effects of slowing down other things. For example, just one example, mortgage rates are linked to the 10-year and the 30-year, not what the Fed sets as the Fed fund interest rate, but very much to the 10-year and 30-year yield rates. Those are determined by the markets. And if the 10-year climbs and the 30-year climbs, it means the mortgage rates will climb. And already we're well into the 7s. We may even touch into the 8s if the treasury yields continue to climb. Okay, we can skip this one. And in the past, as I mentioned, we have the strategic reserves of petroleum that the US keeps for emergencies and war. The green line is what we used to have as barrels of inventory, and Biden has used this to keep oil prices lower over the last year and a half. But now we're only at about a third of the original inventory. So for one, if we had a shooting war and we needed oil, we would kind of be screwed. And second, as just being prudent, I don't think that that Biden will allow more of this reserve to be used, despite oil prices, gasoline prices going up now. So it could be we are at the mercy of supply and demand, where Biden was influencing the supply side, but no longer is able to. And if demand proves more resilient, unemployment stays low, GDP growth continues to be above 0, we could be in for a price shock. Now, the Fed has done its part to try to reduce and sell some of the US Treasury bonds that they had via previous QEs. Some of that went into something called the reverse repo market, which is a stealthy way for banks to lend bonds to, for banks to have excess cash put at the Fed, and the Fed would pay interest on that. So the Fed is secretly pumping a little bit of liquidity into the banks via this mechanism. We touched on the fact that after the banking crisis, the Silicon Valley banks and all that stuff, this new program has also been providing extra cash into the banks, which is providing liquidity. The liquidity picture has competing forces, but it isn't as bad as I think many may make it out to be. So again, the US Treasury issues auctions like $11 trillion worth of bonds every year. And net, we're going to be increasing that this year and into next year by another 2 trillion probably. Treasury issuances of the bills, this is very important, the bills, not the notes or the bonds. This has a leading correlation to liquidity. And we saw earlier in the charts that the US is front loading the short-term bills. So they're selling more of those than the other types of debt. And what happens is bills actually are used as collateral in banks. And the collateral is important in bank reserves because that is actually where bank lending creates a multiplier effect, and it creates more liquidity in the financial system. So this is quite interesting, and if it continues, it could lead the liquidity index, which then could also lead how stocks and risk assets perform. So overall liquidity, it's been sideways, actually. We all thought with the Fed saying they're enacting QT, they're raising interest rates, they're selling off their portfolios of bonds in their balance sheet. Yet those other programs have kept some of that liquidity going forward. Some have speculated that this line of quote unquote ample reserves is something that the Fed is trying to manage because it looks extremely tight and very well managed and just kind of at this level. So the Fed may be using its tools, the Treasury may be using its tools to try to maintain that the bank reserve levels stay. And from the bank reserve levels, you use it as collateral to build more liquidity in the economy. So again, the bank reserve reverse repos are an important mechanism in this liquidity. We have seen some of recent liquidity reverse. Much of that has been what the Bank of Japan has done in the last month. What happened was they started to cut back on their yield curve control management ranges. So net is a very wonky economic monetary policy thing, but basically it means they're taking their dollars, they're selling their dollars and using that to buy Japanese assets. And essentially that means that there's less dollars or less things being used to purchase US treasuries and bonds, bills, and notes. And with that reduction of owners of that, liquidity will fall a little bit. So now it remains very important to figure out if this is just a temporary downward spike or if it keeps going further or if it rebounds. Okay. And as I mentioned, Japan is one of the top investors in all things US. So when they start spending less on US assets to prop up their own economy, then it has an impact on global liquidity. Okay. And global fixed income, we showed the corporate side of this. This is including some of the emerging market sovereign debt. Regardless, from 2023, this is actually a low level. It only gets worse. There's more refinancing needs coming ahead in the next 3-4 years. This will be a burden as people who need to refinance need to find willing investors. And finding the willing investors, if that money goes into the bond market, then there's less that goes into the stock market. Real quick, just for some of you who don't have a sense of this, the dollar and the dollar index is vitally important to how, risk assets and US assets perform. And this is a very broad, just short-term look, but it's almost inversely correlated with strong dollar means a little bit weaker stock performance, and a weaker dollar tends to be supportive of US stocks. In the bigger picture, we were in this range. It's kind of a declining range. So there's a lot of people who believe this will just continue to ramp down, especially below the support level. So we may be in a secular cycle of dollar weakness, which is technically supportive of of not US stocks, but actually international ones. Others have been watching the Chinese renminbi. This is not a very clear relationship, but suffice it to say, China is facing some challenges where their currency is weakening against the US dollar. And given the other parts where we discussed on China, where they're having some serious issues with their property developers, their wealth management firms, people defaulting, big firms defaulting on their promises, there's a little bit of panic and fear. And if people get too fearful, they will move their dollars, their money out of China and probably towards dollar assets. And this could be a very concerning thing that will trigger policy response from the Chinese government. Really interesting, Yellen visited China a month ago, and the dollar like dropped precipitously in the few days after. Conspiracy theorists are worried that this is something that behind the doors Yellen is willing to negotiate with the Chinese government as they're facing their currency weakness. Let's dig in further on China because it is the second largest economy in the world. It is the factory of the world. However, starting with Trump, followed with Biden, anti-Chinese sentiment is extremely strong. And with the Ukraine war and China's support of Russia, they really got Europe to feel the same sentiment. So even just in the US, just the favorability towards China has just collapsed. It's down to 15% from a period where it's 60 and 70%. That's just amazing to see that. The average American is just not happy with China and they're cautious and worried. It has driven net foreign direct investments in China to just collapse. That it's a function of popular sentiment, as well as government regulations, government sanctions that the US is applying on China. Their currency has gotten weaker. As it goes higher, it's getting weaker. You're seeing consumer prices in China falling along with the rest of the world. They are technically in a deflationary spiral here. Citizens in China are worried. They're just not spending. They're increasing their savings here. Exports and imports in China have both fallen to negative levels. That is not a good sign if your country is healthy. You need to import things to make things in factories and then export them. Well, that doesn't look like it's been healthy since April. Specifically to the US, China is definitely, this is US imports from China. We peaked out around 20% and then it's just fallen, it's dropped. Interestingly, that drop has also seen imports into the US primarily from Mexico and Canada, which is exactly the geopolitical strategic choice that you would want to make. You don't want to rely on China. You would rather rely on your NAFTA partners to the north and south, and you insulate yourself from a lot of issues. So to me, that's extremely deliberate. Export prices out of China, they're exporting deflation, which is part of the reason why a lot of people thought inflation would get down to the 2% level in the US. Interestingly, even though China is exporting less, they dominate the electric vehicle market. They produce the most, they export the most. So this red line is exports of finished autos out of China. Where is that going? It's not coming to the US, but definitely to the rest of the world, especially the emerging market economies. Chinese provinces and counties, they are in a crisis. They have a huge amount of non-performing debt that the government is trying to work out here. Total private credit is extremely, extremely, extremely high in China, and this is of concern. Even though China is able to is pretty much self-sufficient in most of the key crops, except for soybeans, which are imported not only for consumption but also to feed their livestock. Climate change has been impacting a lot of things. India has stopped exporting rice, and that's driving rice prices up throughout the world. China is probably okay with rice, as they're getting enough rain and weather for the southern regions of China, which produce rice, but their wheat and other crops are under duress as they've had massive droughts. As we mentioned earlier, the property developers are under major pressure. Wealth managers are not paying out what they're supposed to, and this could be the last time you see China's youth jobless rate, because they stopped reporting it after this last report. An amazing 20% of people 16 to 24 are unemployed, and this is extremely worrisome for the health of their economy, and also for social unrest. Geopolitically, China is really facing major challenges again. Obviously, the US is supporting Taiwan, but South Korea, Japan, Australia, India, they've all kind of agreed to work together to keep control of these waterways. And what's happened most recently, I think this is actually extremely pivotal. Philippines, they elected a new Marcos Jr., the son of the original Marcos, as president. And one of the first things he's done is start to move away from China and get closer with the US. And they signed a new lease on 4 bases in the Philippines so that the US military can grow their presence in the Philippines. That serves the purpose of helping protect the South China Seas, where there's dispute between China and the Philippines and Vietnam. But it also just kind of, I think it's a slap in the face and a shock for China. The previous president in the Philippines was siding with China and opening up a lot of things, pushing America out. But China didn't manage this relationship well enough, and it's clear that there's a backlash against China from the Philippines. And recently there's been something that was extremely interesting. The Chinese Coast Guard was water cannoning, the Philippine Navy and fishermen, and basically saying, these are our waters, you're in our waters, go away. And the Philippines are extremely unhappy with that. They had crashed an old military ship in one of the disputed regions. They even stationed that decrepit old ship there with soldiers, and it's an outpost, and it's a red line for the Philippines. And they're basically telling China, don't mess with us. If you cross this is it. We're not going to be friendly. The president of the Philippines specifically responded to China. China said, hey, we agreed on this. This is ours, not yours. And President Marcos Jr. said, well, if there was an agreement, it's canceled now. This is really escalated, and I think this is a major headache for China and their ability to claim that region for themselves. I saw this little blip where Philippines has officially cut their hotline with China because of these tensions. And this is all to the benefit of actually the United States and her allies in trying to rein in China's influence in that waterway. However, that is just, geopolitically, these are factors for China to be concerned about. There's a Camp David meeting between the US and South Korea and Japan, which is happening today. This is the US side of the news, and this is from China's side of the news. They're watching closely, and they're worried that there's going to be a de facto Asia NATO, a political, economic, and military alliance that will target and challenge China. So these are all the underlying factors geopolitically that were happening. Now, having said that, China, as their economic problems and risk of default problems continue to climb, and those are biggies. Those are really big ones. I would suspect that China is going to be forced into major stimulus that they didn't really want to do, to try to rein in this slowdown of activities. They're going to probably pump in money and cash. And if they do that, it tends to lead to greater liquidity, greater global liquidity, which in turn helps global GDP. So you're seeing that stimulus money out of China, the excess funding is starting to. This is the leading indicator, and we're waiting for the stock markets and their economy to start to catch that tailwind. Because China has studied Japan's history, they don't want to fall into Japan's 1990 crisis. Japan overextended. They relied too much on their real estate. Their banks basically screwed up, and the government stepped in to keep them from imploding. But by doing that, they've put Japan in a horizontal, slow economic growth since 1990 until recently. So it's been almost 40 years, 30 years of horizontal, slow economic growth. China does not want to fall into that same trap. So this property sector is something that they're going to pay extremely focused attention to and try to keep it from deteriorating further, despite all these companies on the verge of bankruptcy and default. And not to forget, China is still very dominant in the global manufacturing space. They dominate on all aspects. It's not something that you lose overnight, even though other countries are starting to ramp up. We have to keep in mind that China is still the powerhouse for goods. They still control all the rare earth metal processing in the world. So anything electric, anything with batteries, anything with magnets, which is solar, it's wind, it's all the electric vehicle batteries, that is still in the hands of China. They have the most control. That's the bottleneck, and it's a powerful negotiating chip for China. Now, quickly into the rest of the world, I mentioned there's some weather anomalies recently. We have a heat dome in the Midwest and in the South. There's a weird hurricane. Hurricanes typically are on the Atlantic side, but now we have one here on the western side coming up from Mexico that's probably going to head up there, and that's going to create some weird weather anomalies. This is the latest forecast from NOAA. Southern California could get 2 to 3 years worth of rain in just 2 days. If that were to happen, this could cause some flooding. It could cause damage to crops and things like that. We don't know what that will finally happen, but these are things to worry about. Meanwhile, it's winter in South America, but they're having a heat wave of up to 38 degrees Celsius, maybe up into the 40s. That's well over the hundreds in Fahrenheit. This isn't supposed to happen, but it's happening. So the future crops in South America for next year could have some challenges. Geopolitically, we still have other hotspots in the world. This is one that Europe keeps worrying about. There's this Suwalki gap that I don't think anybody really pays attention to except Europeans and NATO. It's very weird. Russia, their friends are in Belarus, and then they're blocked off. But this little bit of land is owned by Russia. So the only way to get here is by sea and going through all the NATO allies and shipping channels, or by this 60-mile little road that allows supplies to go from here to there. And these are neighbored by Lithuania and Poland, and they've been ramping up their defensive and military forces here. in preparation for some surprise attack from Belarus or from the Wagner Group that might challenge or take over that roadway. So in the geopolitical sphere, if things go bad in Ukraine for the Russians and they decide they just need to prod and poke and expand the war, this is the number one most likely area of kinetic war that expands beyond the Ukraine. Meanwhile, Russia has canceled all the safe sea travels of grains in and out of the Black Sea that go through Turkey. So the Ukrainians have also started, sea drones that are blowing up Russian ships. The Russians keep bombing Odessa and other ports in the Ukraine. Essentially what it means is grains that need to come out of Russia or the Ukraine to the rest of the world through the Black Seas, that is all going to tighten down. And these are the countries that have the most impact from a lockdown of the Black Sea grains traversing that area. In the Middle East, a lot of people don't pay attention to this either, but Armenia and Azerbaijan have been in conflict for a long, long time. The Turks support the Azerbaijanis. The Russians supported the Armenians. Now that Russia is too busy with other things to help Armenia, the Azerbaijanis, with the support of the Turks, have been a little bit more aggressive. And this could become a hotspot of conflict if Russians start to continue to lose the war and lose credibility and are unable to support Armenia. It wouldn't be weird to imagine that this gap here would be looking very tasty for the Azerbaijanis to reunite this little bit that is their part. This entails, however, a lot of complicated Middle East dynamics. Obviously, Iran, Turkey, Syria, the Saudis, they all have some interest in one way or the other. And this could trigger a little bit more blatant activities politically, economically, even maybe kinetically. Meanwhile, in India, they've been doing pretty well. The country is growing. The inflation rate is climbing, but there could be continued growth as the Indian demographic is quite young. And with the shift away from China, factories are popping up in India. Specifically to note, Foxconn has just decided to build a new factory there. And essentially that means they're going to slow down their assembly factories in China and move that over towards India. It's a big deal. It's something to pay attention to. And I don't have a slide here to mention that, but the US, Biden invited President Modi of India over, I believe it was in June or July, had a nice powwow, essentially freed up the transfer or sales of US weapons and technology to India. And India responded in kind with a little bit tighter, a less friendly look towards China and Russia. And I think geopolitically, that's a huge and important strategic shift. If that continues, that India moves towards the Western fold, China, again, just has more to deal with, as India is a massive country right on their border with a lot of resources, a lot of technology, a lot of manpower. That is a huge, huge pressure for China. Interestingly, some parts of the world, especially in emerging countries, have started to cut interest rates. That is a telling sign, and this is probably a leading indicator of where the Western developed countries will end up, in the sense that they've dealt with inflation and they're now dealing with slowing growth, and they want to stimulate their economies for this reason or that reason. So watch this area. I think the emerging countries are starting to move. as they cut interest rates to stimulate growth, their stock markets, their economies could be could be interesting for us. Uranium. Most of the world's uranium is mined in Kazakhstan. A lot of it is from Canada. Niger is a major supplier. I think France gets maybe 20% of their uranium from Niger. So they've always been very involved and friendly in that middle Central Africa region. What's happened, however, is there have been coups in all these Central African countries. Niger just happened recently with the support of the Russian Wagner Group. And so this is just a mess. And France, because this is a strategic source of their uranium, this has become national security issue for them as well. So it could be we're going to see a little bit more kinetic activity, geopolitical actions in this region going forward. So what I've found out recently is this ECOWAS is this group association in Central Africa. They made a line in the sand procurement with the coup winner in Niger, basically saying, no, that's not acceptable. You need to restore things. Of course, that coup president is ignoring that, but there could be some kinetic action with this group trying to assert their group decisions on this region. So again, something to watch out for. Just broadly speaking, there are critical minerals that are coming from Africa. Obviously, China has been heavily involved in building out infrastructure and growing and supporting a lot of these so that they can have access to critical metals. And I think Africa is going to grow in geopolitical importance in the next decade. Market volatility. This is just market sentiment and things. Valuation. The market valuation for the S&P 500 is actually still within range. If it bounces around in this range, we're still nothing extreme. So the market could continue to move forward. When we consider the presidential election cycles, we're in the third year of a presidency, and usually the front half of the year is high growth, but the second half tends to be sideways. So if we dig down a little bit deeper into just the third year, we're tracking this momentum quite well. And the market right now is moving down a little bit. It could go down to this range, but is most likely to kind of be sideways and then maybe start to ramp up towards the end of the year. So this is just a reference. It doesn't mean we actually follow this pattern, but it seems to have a historical rhythm to it. The technicals, we just dropped below this 50-day moving average, and so I think the S&P today was at 43 something. So there's a breakdown of that support level, and it means this is a kind of empty no man's land until we hit the 200-day moving average of 4,100-ish. So it could stop a 100-day, 50-day, 100-day, 200-day. There are levels in between. Probably 4,300 is an important level. But watch these levels. As we break through these support levels, it's kind of empty space and likely for the markets to want to keep moving down. The VIX is an index of fear. It's an index of options, of puts and calls. Historically, it's basically when the VIX goes up, there's greater uncertainty, and therefore stocks don't do as well. And there's a seasonality to that as well. So from August into October usually tends to be a spike in volatility, which tends to mean a slowdown or correction in stock markets. So with all that to consider, I'm going to try to sum it up in a few things that I think are the main directions. I think inflation is going to be range bound from here around 3 or 4%. But towards the end of the year and into 2024, I think inflation wants to rise again. I believe that the supply of critical commodities is falling for several reasons. And I think the demand and growth, GDP growth, specifically in the US, is going to slow, but not go into recession until sometime in 2024. So I think the US recession has been delayed. Definitely didn't happen now. And with unemployment at 3.5%, there's a lot of room for it to go up before we start really stressing about it. I do think, though, consumer spending is going to fall from now well into 2024, which would probably precipitate that recessionary call and the recessionary vibe in the beginning half of 2024. I do think the Fed will want to pause sometime in Q3 with their interest rate hikes. It is incremental. However, the growing pressures, and if they start seeing unemployment start to move up, it's a good excuse for them to say, wait, I'm going to do what I did in June, kind of leave it alone, step back and watch. And if it's still not going the right way, the next month I'll raise. I think they're going to be in that mode. And depending on when the recession starts, we'll probably see maybe even rate cuts mid 2024. Okay. China is under major duress, multiple fronts. I think new stimulus is coming. I don't think they have an option, short of just all out starting a war on Taiwan, which could distract their domestic markets. Other than that, I think they just need to bite the bullet and backstop a lot of the defaulting action that's going on with the property developers and the shadow bankers. They're going to try many things, but it's not going to be in time for a major impact in this year. I think that will all start to reflect more towards the next year. Global liquidity, which I think is actually in the modern economic structure, will be the driver of risk assets going up. And as liquidity climbs, risk assets like stocks and real estate and crypto, those all tend to move upward. I think counterintuitively, it begins to rise again at the end of this year. And we will see that interest service rates on all the bonds that all these countries are issuing, they're going to become burdensome. They're going to become a threat to fiscal health and confidence in a country. And that the central bankers will be forced to try to limit those yields from climbing too high. And once they do that, that is essentially QE, which actually is supportive of global liquidity. In the meantime, I believe commodity prices, because of climate issues, because of supply issues, because of healthier than expected demand, I think commodity prices are going to be in a secular strong cycle. I think the markets in the US will feel the weakness, but there will be a baseline and a sideways action and possibly finishing off the end of the year strong. The dollar remains strong, specifically now that Japan is loosening their controls on their yield curve control QE system. Meanwhile, China, which is obviously the big player, needs to deal with its own internal economic factors, which is slower growth, slower economy, and now defaults rising. I think China will address that, and eventually the dollar will get back to it. What I think will be a secular trend of, it's really gone up. I think it wants to come back down in a secular, longer term, maybe a year or 2 year cycle of weakness. That would be actually positive for investments outside of the U.S. Specifically, I think the commodity producing and exporting countries in emerging markets. and also Southeast Asia, which has a young population that is still economically growing okay. Real estate, I think, continues to mean revert down. I don't think the pressures of the commercial real estate, and I think even residential real estate will start to feel some pressure. I don't think that reverts until we restart QE and yield curve control. El Nino, it seems like it's a doozy year for El Nino. Whatever the effects that we used to think about historical El Nino impact, it could be very well that Tonga volcano explosion amplified it because it created so much steam in the atmosphere, which causes heat retention on the planet Earth. So it feels like it's been much more volatile. I think people are saying it's the record of highest heat on ever. I even saw a crazy little blip about some place in Iran that logged in like 81 degrees Celsius for their heat, high heat rating. That's just unimaginable that can happen on planet Earth. So these factors are likely to still have impact on energy demand and crop productivity. Finally, the U.S. elections, it's looking more and more like Trump will end up still being the GOP candidate. He has a mile long of lawsuits that he has to deal with. I still think that this rematch between Biden and Trump will happen for next year. But I think Biden ends up winning and Trump will lose just by a popular vote mathematics. Let's say 20 or 30% of the popular vote goes to Trump because his core base is there. But I do believe many Republicans and the independents will just vote against Trump. And for that reason, Biden will win by default. So let's see if that happens. Let's hope that Biden remains healthy during this period and no other crises pop up. I mean, I don't think the economy is going to be great for 2024, which is usually a very negative thing for the sitting president. However, Trump being quite a polarizing figure, you love him or hate him, and I think the Democrats plus the independents plus quite a lot of the Republicans who don't like Trump, if they all vote against him, he can't win. So that's what I think is happening for the second half of 2023 into 2024. The sectors are still relatively unchanged. Money markets right now are extremely attractive. So the very short end, the 0 to 3 month treasury bills, they produce up to like a 5% type of interest rate. And if the Fed continues to raise interest rates, they'll benefit from that. Other dividend paying or cash flow generating sectors, those can continue to do well. I have a feeling that when we talked about the first half of the year, the Magnificent Seven, they are really quite expensive now. My bet is if the stock market is going to do well, it'll be not so much that those AI stocks continue going up, but rather the other 493 start to float up to catch that. So I would invest in the 493 rather than the Magnificent Seven. And if commodities start to perform well, I think the natural resource sector would be quite attractive. Okay, that's it for me. Remember, a lot of things going on, but don't panic. Questions or comments, concerns, feel free to reach out. That's all for now. And Robin Lynn signing off.